start the recording right now, and on Monday or Tuesday, I'm going to redo this discussion we just had on the bull put idea, buying an extra put, what's wrong, using the goose example. We'll get that posted Monday, shortly after, Monday or Tuesday, shortly after we post the archive from today's presentation, which is going to be going from here on now. So we'll get that going as well. All right. Larry H. asked a question. He says, I saw a statement from you about a cheat sheet for income methods for married puts. How do I get it? If you are a Blueprint owner or a Fusion subscriber at RadioActiveTrading.com, you can access it directly from logging into your RadioActive Trading account. Okay, so I'm just going to go to RadioActiveTrading.com. Well, okay. Caps lock's on, sorry about that. Okay, so I'm just going to RadioActiveTrading.com there, and we're just going to log in to our basic account. I'm sorry, hold on, Larry. Should have been logged in before the webinar, that was my fault. All right, so here we are at RadioActive Trading. Now, if you're a Fusion subscriber, you're a member of the Fusion service, what you could do here is just click on the section for members only webinars and white papers. And that'll take you to a variety of members only webinars, 5 ways to milk your radioactive profit machine, playing the bear side of the market, 5 ways to manage income method number 5. But over here in the members only section, you have the income method cheat sheet, triple your radioactive gains, and so 2 other examples of married puts versus long strangles. Now, if you're just a Blueprint owner at the time, right now, you're not subscribed to Fusion, you won't see this. You'll see the listing of the tools available for Fusion subscribers and ability to subscribe at any time. And if you just bought the Blueprint, remember, you can get your first month of Fusion at RadioActive Trading for only $10 for the first month, $69 a month after that. But as a Blueprint owner, this pod down here, you can access your latest Blueprint revisions. You can upgrade to the Home Study Kit to get the other Mastery Series CDs. But click on the Blueprint Owner Only Webinars, and there will be an additional link here. Oh, that's right. This account isn't set up that way. But you'll see an additional link there. Oh, it's in here. I'm sorry. I apologize. So click on the revisions, Larry, as a Blueprint owner, and you'll see the income methods summary. Okay, so it's pretty much the same thing there. So Blueprint owners can access it there by going into the latest Blueprint revisions. There's also a wealth of information in the Blueprint owner only webinars. But if you're a Fusion subscriber, just click on members only webinars and white papers to get the cheat sheet and the summary information. Okay. All right. So that's the answer there, Larry. And by the way, just use the same email address and password that you use for your PowerOptions account or that was given to you when you purchased the Blueprint to log in. If you're just a Blueprint owner, you're not paying a cost for it. You have sort of a free registration account where you can get your revisions and updates, see the Blueprint owner only webinars, and of course other information, but you're not charged to log on. Okay, that's not a billing there or anything. It's just where you can access the additional information. All right, let's go back to the main PowerOptions page here. Going to get to Fernando's question. It's also related to radioactive trading. Fernando wants to know, how much of the fundamentals are important in a married put position? Okay, well, I think they're fairly important, both fundamentals and some technicals as well. And you said, which fundamental criteria do you think are important in a married put? Is it more important that the married puts, it's more important the married put structure or buy the stock under fair value? Okay, let me take the third question first. Is it more important for the structure of the married put or buy the stock under fair value? For me, it's more important on the structure itself, Fernando. If I'm getting into a married put position, I'm following the rules in the Blueprint, talked to a customer a week and a half ago who was getting in TEAM, and I think the stock was at $76 or $75, and now it's at $86.11. It came up on the list. I didn't know the stock. It was during a coaching session. I think he entered that position. I did not. Now I see it at $86.11. I kind of regret it. In any case, let's go. So when I'm opening the married put, Fernando, yes, I'm going to put in my criteria. I want this risk to be less than about 7.6, 7.5%. Now, fundamentals to me, I need the stock to be in a certain price range based on my account size and what positions I already have open. I do look for stocks that have an earnings per share growth of at least 5%. And of course, I may look for a market cap of, let's say, mid to large cap stocks as well. We look for good average stock volume. That's the average of the last 90 days. This is measured in thousands, so it's a minimum of 300,000 shares per day. I might pop that up to 750,000. Oops, sorry, there we go. Just personal preference. No statistics for you whether that's better or not. So I would be able to open 5 married puts right now, and Marathon would be questionable based on the positions I have open and the capital I have available to trade. But Planet Fitness, which was a really successful trade for me last year, IDTI, Huntsman Corp, and ConocoPhillips would be the positions I'd be interested in. Of those 4 or 5, all of them are within my maximum risk range. If there's a 5250 here put on Planet Fitness, I might be more interested in that than the 55. But in any case, all of these are within my risk threshold. So even if I buy into these positions, now I'm going to do research and analysis, Fernando. You've seen webinars on that. I'm going to look at the stock chart, the company information, news, profile. I'm still going to do my research and analysis. But even if I didn't look at the fair price for the stock, even if it's at above its 52-week trading range, that it's hitting new highs, because of the structure of the trade, even if I'm wrong and this stock now falls 10 to 15% after I get into it, my loss is only going to be 3, 4, 5%. The structure to me is more important because I know that even in the worst case scenario, the stock falls 20% the day after I get into it from some completely unexpected news that I could not find on a chart or anywhere else, my maximum loss can't be more than 7.4%. And if it happens the day after, the week after I enter the trade, even though it dropped 20%, I'm probably only going to be at a loss at 5% because there's still so much time value left on that put. That's why the structure is the most important. Now, we do want to look for good fundamentals. We do want to look for good stocks because I don't want to take a loss on every position. I'm just saying that the structure here for the ones I'm wrong on that completely go against everything I thought was going to happen and everything that the chart showed me, having the control of the proper structure is more important than trying to put yourself in the wrong structure and taking a 15 or 16% risk because you're really sure that this stock is bullish based on your other technical indicators, okay? That's the danger, because if you're wrong on that stock, you've now essentially taken 3 times the loss you would have taken on a properly structured married put. It's not worth it. That's the whole idea of the protection, is to stick with the methodology. Now, I introduced just a couple of basic fundamentals that were already in the default search. Why am I not looking for more things such as price to book, price to sales, PEG ratio, PE ratio, which I might put in, okay? Why am I not looking at more technicals with MACD and Bollinger Bands, which you hear me mention when I'm doing other strategies for bull puts, or even trigger points for management in my married puts, my bull puts, or my diagonal spreads? And a lot of that has to do with the construct that we've put together, that we're looking for that certain combined list, okay? We analyze this just about every 8 months to a year, year and a half maybe sometimes, but Ernie and I constantly look at this. This is how Kurt started, and he felt that that particular list worked best for his needs. It was also something Ernie agreed with. So he stuck with that list, but then enhanced it by combining it with other like stocks and other like lists. So why am I talking about it this way? A lot of the things you'd consider to be good fundamentals, such as maybe at least 4 quarters or 3 quarters of positive earnings in a row, an earnings growth of at least 8% quarter over quarter or year after year, a good average stock volume, average trading volume, good range of profitability, good yield, ROI, for example. That's kind of all taken account in order to be included in that list to begin with. So that's why there's not dozens of entries for technicals and fundamentals on the default married put search, because it's restricting to a list that already includes most of that. that both Ernie and I feel is the right list to use. The list we're using has outperformed just doing married puts on the SPY or the S&P 5-star list, at least in 2017 to 2018 when I last checked it. Okay, so this list was performing better with this strategy. I'm not saying it performed better with all strategies, not at all. I'm saying as far as the married puts looking for growth over 4 or 5 month periods, the list we're using that's already in the default, Fernando, I know at least of last year, outperformed using the other lists. Okay, the main other lists. I didn't check all of the company lists that we have there that we've programmed in, but most of the common ones investors would use, I compared that against after January 15th. Okay, so, or, you know, I apologize, from January 1st, 2017 to January 5th, 2018, did it based on if I just opened a new position each month that was at the top of the lists, and versus when I actually opened my positions, if I had selected from a different list, would I have performed better? And the answer was no, I would not have. So the NASDAQ 100, SPY, S&P 5-star did not perform as good as the underlying movement as the list that we're using in the default screen. So that's why you don't see more technicals and more fundamentals in that default search that's listed either by risk or by earnings per share growth. But yes, I make my subtle changes, so I already narrowed it down to the only 4 trades I would make in the strategy, and there they are, 5 trades. But again, I just mentioned MPCs, questionable because some of the other positions I have open right now, I don't know if I'd want to put in the 9177. I couldn't do 200 shares, it'd be $9,000. I don't know if I would do that right now with the capital I have. I know I'm closing 2 positions within the next week or two. So in the radioactive trading portion of my portfolio, not entire portfolio, but the radioactive trading portfolio. So I'd be able to do it then, but I probably wouldn't do it now. Okay, so that's that, Fernando. Why aren't there more fundamentals in there? Is it still important? Yes. As always, maybe I'll redo this one in a couple of months, but if you go to the webinars page, powerop.com.webinars.asp, I'll just send that to everyone in the link for those of you that aren't familiar with it. This is our webinars page. It is a public webinars page. You don't need to be logged in to access it. And in the Power Options Tools section, maybe? Nope, not there. Okay, let me go into Option Strategies. I didn't think I put it in here. But as you scroll down, here you go. Right here, Fernando. This is an old one. It's about 3 years old. Why haven't I updated it? Well, it's because the exact same content I would present today. So I could redo it, but it'd be the exact same content and the exact same discussion. But what this shows you is that this webinar here under the option strategies from July 9th, 2015, Power Options for Radioactive Trades, I talk about identifying it using the search tool. Why we're using that criteria, rediscussion of why you don't see more fundamentals and technicals into that default list because it's already taken account with the stock lists that are being used. You can make adjustments on your personal risk-reward tolerance. I showed that already. Create your own stock lists, and then tips of technical and fundamental criteria. There's a little bit more insight for you. And then number 5, the 5 steps I use to research and analyze the stock with the more information button after it's come up in my search. Okay, so that webinar there, if you have time over the weekend, just go to webinars, powerop.com, webinars.asp, click on Option Strategies, 7/9/2015, Power Options for Radioactive Trades. That essentially gives you every insight, pretty much every insight into how I use Power Options on a daily basis to track my positions as well. Okay? Mark J. The column percent EPSG is what on the married put scanner? Okay, well, it's available on all 23 strategies we support, but what we're showing there, the results here sorted by percent EPSG. This is the earnings per share growth, the company's change in earnings from last year to the estimate for the next year, divided by the earnings from last year expressed as a percent. It's the expected growth from year to year, Mark. And as you saw here, our default, we're sorting it by earnings per share growth. Why? Well, it's Ernie's and my thought, it's Ernie's thought, and I believe it with him, that the positions that offer the highest earnings per share growth, positive earnings, are one of the best drivers of an underlying security. So if you expect the stock to grow 10%, or you want to try to potentially find stocks that you feel grow 10% in the next 6 months or the next year, you better make sure that the earnings per share growth is above 15, 20% to help drive that price. If it's a negative earnings per share growth, you're just hoping on a bounce from a negative amount or probably bottom feeding there, Mark. I'm not saying that's what you do. That sounded wrong, but that's why we use the earnings per share growth, because we want to look for the positions that have the strongest earnings per share growth, and that's why that default was there, to look for at least a 5% earnings per share growth to help drive the stock as well. And yes, in relation to what I just said to Fernando, Mark, once I run my search, now ServiceNow is out of my price range, as we saw. Team is just out of my price range right now until I close a couple other positions in this portion of my portfolio. However, my first research and analysis will come at the one that has the highest earnings per share growth. The risk I know is controlled to whatever I set it to. So I'm okay with the risk, whether it's 7 versus 4.7 or 7.5. Once I put that in there, I'm good, and I know what I'm looking for, and I'm okay with that. So now I start with the one that has the highest earnings per share growth. But yes, I'm going to look at the stock chart, company information, news, profile. Can I see anything in the last month or so of anything negative? Rumors of a change in boardroom members or ousting of a CEO. Was there any surprise in the last earnings that was negative or wasn't as good as expected for the next quarter? Those are things I want to take a look at as well. I'll also look at the search by symbol to compare other strikes and other expirations. And of course, look at the profit and loss chart to run my what-if scenarios. And if the stock does drop 5% in the next 10 days, moves up 5% in the next 10 days, what can I expect as far as gain or loss on the entire position as well? All right, so it's the earnings per share growth. That's how we like to sort it. But if you're more focused on risk, that's perfectly fine. Same default criteria, sorted by risk to keep it simple. Doesn't necessarily exactly flip the earnings per share growth. It just means that here we have some lower risk positions at the top, still have the growth that we're looking for, but just not sorted by the growth as well. That's all. All right. Now to Rhajiv. Walmart. Far out bull call debit spread. Let's just go to the custom spread tool. I'm going to build this on the fly to take a look at it. So we're looking at WMT. Bull call debit is similar to the bull put credit we were looking at earlier, just using calls and paying a debit as opposed to using puts and receiving a credit. Similar risk reward profile. Rhajiv's position happens to be out to October. Okay. And this has kind of gone now to an out of the money. He's got a 95, 97.50 bull spread. Okay, so we sold the 97.50 call, bought the 95, and it's at a debit of 120. So I'm going to put in a cost of 240 for the long, received 120 for the short. So there's your debit of 120 against a risk of 250. Stock is now below both strike prices. Okay, so the question is, how will I manage it? Okay, you have so much time on this position. The first thing you have to do is reevaluate Walmart. What do you think? Okay, before you do anything, just look at the position brand new. Don't even consider what you have in here. So we had a recent pop in earnings where you're looking good. Now the stock has sort of come back. It was kind of a Bollinger Band breakout influenced by earnings, but now it's pulled back. You still have 56 days to go on this position. Okay. If you have turned bearish, as we could see now, your debit was 120. If you've turned bearish and you don't think this is a good play going forward, look at it right now. You could sell to close your 95 call for about 255. Buy to close your 97.5 call for 144. That is a premium you'll get back of 111, so it's a 9-cent loss on the spread. You paid $1.20 for. You paid $1.20 debit, you could get $1.11 back by exiting this position, a loss of 9 cents. If you've turned bearish, you don't think this is a good bullish play anymore, you don't want to wait the 56 days, I'd say close now and take the loss. Okay? Is it worth managing at this time? I don't know. That depends on what your outlook is for the stock going forward, because if it continues to drop, you won't be able to get these prices anymore. You won't be able to get this, close to a $1.11, $1.15 close where you only have a 9-cent or 5-cent loss in the position. You have so much time left to go on this. Okay, so what I'm saying there is that I'm afraid you're jumping the gun trying to manage it right now. If this was a week to go, if this was next week's expiration for August 31st, and I thought you were bearish on this, you've turned bearish, again, I say sell to close this for $1.40. You've covered the debit. You now have a 95 call. Oh, no, that's wrong. There, you're going bearish. I'm sorry. I was thinking of bull put spread again. You can't do that with a bull call debit. My apologies. Okay, so normally I would just say roll this down, but you can't because it's the same strikes. So you could move it down. You could liquidate this, take a 9-cent loss, and enter a 92.50 90 call, but you'd only, your debit's going to be closer to 2. Oh, that's ugly. That's right even, isn't it? No, it's about $2. Okay, yeah, so it's about $2 or so would be the debit there, which means if it stays above 92.50 at October, you'd get 50 cents. Not the return you're looking for, but still a good return. But again, you've got so far to go here, you're really not at a loss right now. You're still at break even. I'm tempted just to say close it if you think it's gone bearish now and only take that 5, 9, 10-cent loss on the spread. Don't even try to manage it. Don't even try to worry about it. You were wrong on the direction, so wait till you get a more positive sign. It got buoyed by the earnings, but now it's been pulling back, profit taking. It could still continue to go up. You don't know. You've got time to worry about it. If it continues to fall and you haven't done it yet, well, sure, you could lower the entire spread. You could just sell to close the 95, buy to open the 100. That would be a credit of about 180. So now you're in a bear call spread with a 60-cent net credit on a 2.5-point spread, right? So instead of rolling the short here, if you have turned bearish, sell to close this for the 260, 254, all right, 255 midpoint. Now what are you left with? You're left with a naked call, 97.5. Buy the 100 call for 76, 78 cents. Net credit of about 57 cents total, 60 cents. You're now in a bear call credit spread going forward. As long as the stock stays below 97.50, you'll make 12.9%. Is that the return you wanted? No. But it's better than taking the 9 or 10-cent loss now or waiting longer and seeing a 40 or 50-cent loss as those premiums keep decaying if the stock continues to fall. So that's one option. But again, you have so much time on this now. I'd wait to see a more pronounced trend. Earnings spike happened. Now it's pulled back. You could do what Mark did. You could consider buying an extra put at this time. I wouldn't go to the 95, but maybe a 90 or something for October expiration, or maybe even closer in shorter term. Okay, maybe the 87.50 at 40 cents. But remember, if it recovers, you're going to lose that 40 cents. That's going to be added to the debit. So now your max profit here is only $89 if it goes back up as you're expecting by October, but you could still profit. But if it stays in this range, you're losing 161, which is 16 times what your loss would be right now, somewhere in that range. So that's what I was thinking of there in that question, in that regards, Rhajiv, to this position. Okay, I don't know if now is the time to manage it. But again, if you've changed your sentiment on it, I'd say get out of it, take the small loss now, make it back on another trade that's more positive. Could you roll the one put now to turn it into a bear call credit spread, sell the 95 and buy the open, the 100? Absolutely, but it'd only be about a 60-cent profit if the stock stays below 97.50 for the next 56 days. You added a cheap extra put now, 40 cents for that October 87.50. Well, you saw the outcome there. You'd have a small profit of only 12% if the stock does move back up because the cost of the new put. If the stock keeps falling as you want, well, once it drops below 87.50, which is still about $7 away from there, then you could start realizing a profit to the downside. But if you're that bearish again, I'd say just get out of the bull call at this point and play a bearish trade. Okay, all right. All right, so, okay, Rhajiv again, a follow-up question. This is completely different now, but it's a Rhajiv question. Guidance on a new position on GE. Can I sell the 13 strike call and buy 214 for October? Yeah, you're doing a ratio call spread on top. It's not the ratio spread I would use. Okay, I would use more of a stock repair, but you're saying if GE really recovers in this situation and moves back up. So let's say GE with a cost basis of around 1380. All right. And we have 56 days to October. You're talking about selling a 13 and buying two 14s. Okay. I do it the opposite way, so I understand why you're doing it this way. So you're trying to generate premium here and leave the upside open if it recovers, but you're buying, yeah, so you're getting 11-cent lower cost basis. Okay, so what can I tell you? You got to ask yourself this question. Looking at the graph, does that match your risk-reward tolerance? I can't answer that for you. That's a question you have to answer. I can't do that. The stock repair is more of the opposite, and in this case, it wouldn't work. A stock repair, let's say I paid $13.80, it's now trading at $12.50, but if I bought more than likely at 12 and sold to, see, this one wouldn't work. I want to do it at a credit. For the stock repair I typically use, let me just go out to September. Now that the stock has fallen, they're all terrible. It's not your fault, Rhajiv, just all the premiums are not what I need them to be. Let's say I bought one and sold two. This would not get me back to break even, would it? No, not even close. Not even close. And it doesn't leave the upside open, but it might be a repair because, see, in this case, I'm going to pay about 62 cents for that long, 63, and I'm only getting 30. Let's reverse it. Let's do it 60 and 33. See, now I get a 6-cent net credit. Impossible to get in this case, but a lot of times you can find these ratio spreads where the call that you're buying is less than twice the amount of the two calls you're selling. So I still get a credit here of 6 cents, and if the stock moves up, I get the extra 50 cents. It's a bull call debit mixed with a short call, a covered call, for example. So even though I'm selling two, one of those calls is covered by the long, the other short call is covered by the stock. This doesn't get me to break even because the premiums aren't what I need them to be. But if there are repairs available, of course, the stock repair tool can show you that. Okay. Now, speaking of what we call signature tools, stock repair tool is one of them. I just put a GE, my cost basis, and the stock repair would show me what it is. Follow-up question from Rhajiv is how we use PowerOptions to analyze which strategy is good for high-ticketed stock ETF like Amazon, Google, including SPX. Well, I use the search summary tool as a starting point. So I don't know what your outlook is on these positions. What PowerOptions does not do, Rhajiv, is does not say, oh, Amazon has been doing X, Y, and Z. The premiums are at a regular average implied volatility of X amount. So with that in mind, a diagonal spread of buying 2 weeks out and selling 1 week in time would be a good idea if things continue. We don't do that. Okay, that's not what we do. That's too dangerous. Honestly, that can get investors into a lot of trouble. Now, I'll start off with the search summary tool. And what this does, of course, it just gives you a breakdown of different strategies that you can select. So I can just say covered call, which I wouldn't do on Amazon. But let me add in bull call debit, bull put credit, long straddle or strangle. Wouldn't do married put just because of the cost of the stock. I'm not doing a collar or a married put or a covered call or a cash secured naked put because of it. Don't think I consider iron butterfly or iron condor because I have a sentiment. Your sentiment's either somewhat bullish, somewhat bearish, or if you're neutral, you would select that. You could select to see all the neutrals, all the bearishes, all the bullishes. A calendar call spread. Yeah, that's pretty much what I would be looking at. So I'll just go ahead and hit submit. Oh, you can change your expiration. Let's go to October since that's where your questions are. So this gives me a breakdown of some of the positions, the percentage return, the calendar call diagonal spreads with October and June options, some of the bull put credit spreads, the net credits, the returns, and the max risk there. Compared to bull call debits, long straddles, just so you know the total cost basis. I'm not saying that's the best strategy, but it depends on what your outlook is as well. And then some of the long strangles, okay? So this gives you an idea of what's available. This is my starting point, and then I can go further in, but you really want to sort of base it on what is your strategies that you prefer, and do you think Amazon is in the position for those strategies? If you're neutral to bullish, neutral to bearish, what are the best strategies to use at those times? Well, that also has to match what you're comfortable trading and what you know you're trading, rather than just trying to start a new strategy off the top because you think stock's going to do X or Y. You want to know the strategy as well as know the technicals and fundamentals that led you to the direction of the stocks that you mentioned. Okay? But I'll start with a search summary tool and move from there. But typically, as you know, I generally stay with my forms of calendar spreads, call or put, depending on my market sentiment, bear call or bull put credit spreads, depending on my sentiment of the market, married put positions, sometimes standard collars, and then occasionally long straddles and strangles around earnings events also. If my overall sentiment on the market changes, I may start dipping more into more bearish strategies, not short collars per se, with shorting the stock, selling a put, and buying a call, but doing collar spreads that actually mimic a bear call credit spread even though I'm buying the stock. Okay, it's something that I might do. Okay, Fernando, this is something that Kurt, myself, Ernie, we've never done. We've never commented on ourselves. We've never looked into it. We never traded it. Fernando's question is, are there some special points of attention to use a married put structure with futures and futures options instead of using stocks? Can we use the married put on the futures with the same rules of the stock? Not really, because you can't buy the underlying of the futures. Okay? So everyone says, well, instead of doing the married put, and Fernando, you've heard me talk about this in several webinars, instead of doing the married put, why don't I just buy a long call and buy a long put? Well, see, then you're creating an in-the-money strangle. It's not the same as buying the stock. It doesn't give you the same risk-reward profile. It's a leverage trade, so that means you're taking on a 30 to 40% risk instead of a 4, 5, or 6% risk. That's the nature of the position. You have to own the stock in the put to get the single-digit risks. In the futures, you can't own it, so anything you do by buying a call and buying a put to try to mimic a married put position, you're still just creating an in-the-money or an out-of-the-money strangle position. It's not mimicking a married put with the futures because you can't own the underlying outright. Both are leveraged equities when you're doing that in the futures market. So you can approach it as a strangle if you want to. And that's, you could say, well, let me buy an in-the-money call and buy the same put I would use, being 1 or 2 strikes in the money, at least 150 days out in time. But you wouldn't want the time value risk of that future to be more than 5, 6, or 7%. But it's not going to be mimicking a married put. You're still in an in-the-money long strangle at that point, which is a leverage position. You still might take a 30 to 40% loss if the stock is between the strike prices, either at the long call future date, if you haven't made any adjustments, or the long put future date, if you haven't made any adjustments and the stock commodity remains between the 2 strike prices. Okay, so and that's what kind of is going to happen there with those. That's why the futures aren't the same, because you can't own the underlying. Okay, Rhajiv says on Intel, your married put position, your bear call expired. You're left with stock and a put of 50 strike for January 19. Okay, well, there's still some time on Intel, of course. It's like the Ollie position I have now and one other. So you're still waiting to see there what movement. Oh, what happened with INTC. Let's just take a look here. Haven't looked at Intel since our last conversation. That's good. Yeah, you've got earnings probably sometime around October 25th. It just hasn't been confirmed yet. But yeah, it's had a decent movement today, it looked like, even though it's not quite at 50. You're holding the 50 put. Yeah, you've been declining, but it does look like it wants to come back up with today's move. It's pushing it, so yeah, but the last time oh, that's so weird. It's almost a mirror image of the last month, isn't it? You hit the bottom band and then it came up to here and then boom, almost hit the bottom band and then coming back up to here. And of course you are getting Bollinger Bands that are condensing, so it might be starting to channel, which for you is good. If it stays in that channel, you can continue to do 50 or 52 income method number 6 plays, or potentially you could do the just income method number 1, although I know you don't like to cap the upside gain with that income method adjustment on the position. But here it was condensing. I guess this was the earnings drop. Came back up and then sort of went down again, but looks like it's trying to come back up. So it gets up here, that 48, 50, 49 range. You're going to have some good premiums on that 50 strike there to use for an IM6, possibly an IM1 even. And who knows, if it moves right above 48 to 48.50, you might be able to do a 5 by buying the 48 and selling 2 49s or 2 50s. That might be pretty interesting. That happens too. Going shorter term to September, of course. But yeah, it looks like it wants to have another crossover to the positive side. Looks like RSI is going back up here. Technically, it looks better than it has recently, but it's just strange. It's that little almost mirror image of itself. And it was the same thing kind of... No, it wasn't. Okay, I'm sorry, yeah. I was reading that wrong. Sorry, yeah, it wasn't the same thing the last time. So that's kind of interesting, but it has that mirror image right now as well. Okay. All right, yeah, so Fernando points out that yes, he uses ITM strangles with the futures. Just be careful, Fernando, because you know that the risk is usually going to be a leveraged risk of 30 to 40% of what you invested into those futures. I know that Sam and even sometimes Rhajiv, if they have a straddle or a strangle open, they'll sell premiums in the near term. So on the futures, you own a long future, you buy a call future, excuse me, versus the put future there, you're playing it in that fashion, and then you could sell a call shorter term to generate some income, but remember how that affects the entire trade. You'd actually have a large loss if the commodity shoots up because your put would lose value. The call would gain value, but then it would be countered by the intrinsic loss on the short call. That's like doing a in-the-money long strangle and selling a call in the inside of it. Let's just look at that real quick on SPY, for example. Once I get my, there we go. Let's go back to the custom spread tool. Let's change this out now to SPY. So if I did an in-the-money strangle on SPY right now, what Fernando's sort of talking about, I go out to, let's just keep it September 21st, standard expiration. I know it's shorter term than I'd prefer to use, but let's say we buy a 270 maybe? No, that's too low. Let's buy a 280 call at around 9. And at the same time, let's buy, the put I'd probably buy would probably be a 292 put. If I was buying SPY now, it'd probably be around the 292 put to do a married put. We're just going to buy one of each. Okay, so instead of a 4, 5, or 6% risk, oh, this one's not bad. It's about a 20% risk. Sorry, folks. There at 285, but I only invested 1484, but I'm risking 20%. Remember, if you take a 20% loss, you're going to need about a 29 or 30% gain on what you have remaining to get back to break even. Okay, but what I mentioned that Sam or Rhajiv has mentioned, that Sam has mentioned he's done in the past in some of these situations, is we might go shorter term. Into September 7th, I might sell a 289 call for $1.15. Okay, so that's going to really lower the cost of the position by about 10%. But remember what you've done now. You have now you sort of have a diagonal call spread with an extra put. That means if the stock moves up, what happens? You have a capped gain on the diagonal spread. Whatever gains you make on this 280 call are eventually going to be countered by the 289 call, which is going to go to a delta of 1 or intrinsic value on September 7th. But then the whole time, that 292 put you paid $6 for is losing value. So, you see a maximum risk of 32%. How did that increase? Well, it increased to the upside. Okay, because if it continues to go up to 300 or 310, we should all be so lucky, I guess, but if it goes up to 300 or 310, you get this sort of intrinsic difference of 9 points on the position, but your put goes to 0. So you're still down that $470, $450 here, or 32.6% of the cost invested. And if you sold a put, it would look the same, the opposite direction, right? Instead of having infinite loss, not infinite loss, but having the maximum pegged loss to the upside, it would now be to the downside, but you could still profit here on the call side if it continued to move up. All right, so that's not something I do, Fernando, by the way, with futures. I don't trade futures. It's not something I've looked at, but you can't do the direct single-digit risk mimic in the futures because you can't own the call future that has the delta of 1. Right? You can go close to it, but then it'll be very expensive. You can get close to a higher delta, but a call option will never have a delta of 1 unless it's right at expiration for the futures as well. Okay, so that's the trick there. Why do we get 5 or 6% single-digit risk? Is because we own the stock with a delta of 1 and we have a put ensuring that position. When you try to mimic stock ownership by using a synthetic, by just buying a call or buying a call and selling a put, you don't have that same 1 delta against the protection of the put. Right? So you're not going to have single-digit risks. You're going to end up with a double-digit risk, or maybe even as high as 30 or 40% risk that I've seen in some of the in-the-money strangles that are set up incorrectly. Okay. Well, ladies and gentlemen, we are at 5:36 p.m. Eastern Time. I do not see any other questions that have come in, so we're just going to go here now and wrap up real quickly. There's again, I just wanted to remind everyone that today's material are my thoughts on your questions, designed mainly for educational purposes, increasing investing performance and options knowledge, I hope. Any stocks or options discussed today should not be taken as direct trading recommendations or suggestions. Of course, options do involve risk, and they may not be suitable for all investors. And once again, I forgot to take off my disclaimer from a month ago, 2 months ago, really, related to the 4th of July holiday. That's okay. You like what you saw today with some of the tools. We took a look at the custom spread tool, of course. We talked about the search capabilities. What we saw in the married put search today is also available in 23 of the most commonly used option strategies, from credit spreads to strangles, covered calls, simple buying calls, and buying puts as well. But if you haven't tested us out yet, just go to PowerOp.com, put in your name and email address, and you'll be able to test the tools for 14 days, no credit card information required at all. Oh, sorry, and after that, mouse is jumpy today. After that, our subscription levels start at $40 per month for the end-of-day service. Most popular is our delayed service at $60 per month. You can see more details with the historical back testing. We looked at a little bit of that today when we looked at those back-in-time August put prices for GOOS on August 13th and 15th. But our historical tools allow you to search in the strategies on your criteria, going any date back to April of 2006. Plus you have access to the full option chains for all securities, optionable stocks as far back as they go to April 2006 as well. So you can add that on top of the delayed service. That's just a total of $100 for both delayed and historical. Of course, we do offer a real-time service, and then the premium service takes into account everything, real-time, historical, plus access to the API as well. Now, if you want to check out other free educational information this weekend, we had mentioned there that Fernando might want to take a look at that Power Options for Radioactive Traders presentation from July 9th, 2015 in our options strategy section at the free webinars page. But again, check out the blog as well, blog.powerup.com. You'll find a lot of other strategy discussions on our webinars page. You can always check us out on YouTube just under the user Power Options. Well, if you think of any other questions at any time, just remember you can send me an email, support@powerop.com. You can also reach us at support@radioactivetrading.com. We are available during market hours. You can reach us at 302-992-7971. For those of you who are currently on a trial or a subscriber to Power Options or Fusion service at Radioactive Trading, you can schedule a coaching session at any time. For subscribers, of course, they're completely free, and it's essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. Well, ladies and gentlemen, thank you again for joining me. Mark, I do apologize for not recording or not getting the full recording because the system did that weird shut-off when it switched screens on us. But I will put together a presentation for you Monday or Tuesday and have that posted by Tuesday night, Tuesday evening, hopefully by 5 o'clock. 6 o'clock probably. But in any case, on our discussion about the bull put spread management, my thoughts on adding the extra put, which I understand why you did, and I don't think it's flawed. I just think that maybe buying to close the short put first, if you're still bearish, and leaving the long open, gives you the ability to re-enter the bull put spread by selling a put at a later time if the stock does recover. Although you could do that too right now. You could still probably create a bull put spread on the additional put you bought, I hope, based on the premium, and have 2 bull put spreads that hopefully work out for you now that the stock has recovered. But I'll get that back together for you Monday or Tuesday, and I'll let everyone know when that's posted. And I'll get this one posted probably sometime this weekend or first thing on Monday. The rest of our discussion today, minus the beginning discussion that Mark presented with us for the bull put spreads. Ladies and gentlemen, thank you again. Have a fantastic weekend. We will see you soon. Good night.